Okay. If you thought that there are no surprises, well, the governor has disappointed us. In fact, has surprised us with a very big one. Growth upped to 7.2%. There was an expectation that, after that blockbuster Q4 number, there is a chance. But after the political uncertainty, those hopes got watered down. But the governor has come with a 7.2% growth upgrade from an already high 7%. I think there are two people, at least SBI and Setty, which are in the 7% plus category. But this will be a surprise to the rest of the economists. And CPI, I think it's important to note the vote. While it is the interest rate and the stance has been maintained as in the previous policy, the interest rate support has come only from 4 out of the 6 members and not 5 as was previously the case for the stance. In fact, for the rate, I think it was a full house that supported last time. This time there are 2 people asking for a rate cut. So that puts the, expectation of a rate cut a little more in people's view. But to be fair, the governor was absolutely clear in his tone that the Reserve Bank is cognizant of, inflation, the last mile inflation coming down being difficult all over the world. And therefore, it doesn't look like it's very imminent. But clearly the fact that 2 people are asking for both a change of stance and a change in rates or a lowering of rates is very important. It can't be bypassed. So growth higher and inflation likely a small, foothold that things could get dovish in the year makes for an excellent policy for at least the stock markets. I was just noticing the bond market, not much of a move. I mean, it was 7.019 before we went into the policy. It is 7.018 after the policy, so not much of a change over there. Let me get our experts to comment. We've got Kaushik Das, Upasna Bhardwaj, we've got SBI Managing Director Mr. Setty, Shobhit Mehrothra from HDFC Asset Management, Rajiv Anand from Axis Bank, and in a bit even Mr. Ashwani Kumar of UCO Bank will be joining us. Well, first to the economists. Upasna, 7.2, will you be pushed to upgrade your own forecast?
Lata, we are surprised with that upward revision. We were expecting them to retain it. We are actually expecting 6.9%. So we were already lower than what RBI was earlier estimating. So this upgrade, of course, probably they've taken cognizance of the overall previous revisions and done some changes. But we believe that somewhere the global slowdown in the second half of the year will start pinching, and we will see some slowdown then. So I think it's a little optimistic, but we'll see how things fare. At least for the month of April and early indicators of May, growth has held up well. So the first quarter may still tick off as per RBI's expectations. But beyond that, I will have to remain a little watchful. But otherwise, I would say that besides the GDP upgrade, overall the policy is fairly in line with what probably we were expecting or the markets were also expecting. It's a fairly balanced tone that RBI governor has maintained. And, the emphasis and the complete focus still remains on ensuring that the 4% last mile disinflation will have to be attained, and they have to get the confidence before they can really act. I think that is one big key takeaway. But besides that, I think it's a very balanced tone, and that's fairly positive otherwise.
Yep. Actually, even if the bond markets have not moved, if anything, very marginally, the stock markets have clearly given a big thumbs up. At the moment, almost racing to a 1% gain. So the upgrade in growth is perhaps, stock markets normally look at central banks as the conservative element. And if the conservative element is talking about a 7.2% growth, then the market has something to cheer, at least at this point in time. Kaushik, key takeaways?
The upgrading growth is a good development, but we have to think whether that upgrade will come with some bit of monetary easing or it will come on its own. I would guess that in order to get a 7% plus growth in FY25 on the back of 8.2 last year, and the fact that fiscal consolidation will continue, you can't maintain this kind of momentum unless you give some monetary policy easing. And today we have made one step closer to that by 2 members calling for a rate cut. So we are making all these baby steps towards a monetary easing cycle. probably by the time we come to the October-December quarter, we could end up getting some rate cuts, because remember, monetary policy is always forward-looking and it takes time for transmission to take place over a next few quarters. So I guess 7.2%, you were mentioning that inflation number all were below 5%. It's still been maintained at 4% handle for all the quarters. But now if you see the growth numbers, everything is above the 7% handle. So it's kind of a balanced kind of number between growth and inflation. The other thing which Governor spoke a lot about and which is important too is the financial stability angle, that whether you look at the banking system or you look at the financial system or the external sector, everything looks pretty strong. And going forward also, RBI will make sure that the macro financial stability remains strong. So I would guess like by the time we are October, December, by that time the Fed has already moved, we could end into a rating cycle starting from that quarter.
Okay. Well, once again, I'm lured by the markets. The governor's of 7.2% has certainly taken the stock markets, the stock indexes, the Nifty index above the 23,000 mark. We have been there, done that, but after that big receding of the markets, this will definitely come as a bullish shot in the arm for the markets. Shobhit, Mehrothra of HDFC AMC is with us. Any thoughts, takeaways for the bond market?
Lata,
Shobhit?
I think, Lata, I think the big takeaway for the market is going to be that the fiscal position, which is already pretty strong in a high growth environment, in a positive growth environment, I think the fiscal position would continue to be the hallmark for the bond market. I think 5.1, even if it is not improved in the full year budget, even if we have just at 5.1, I think achieving or bettering that by the March 25 is still a distinct possibility, which means collections will be solid, robust, GST collections, direct taxes, indirect taxes, both can contribute to improving the fiscal position. And for bond market, I think with JP Morgan bond index inclusion, flows and fiscal remaining positive, I think bond market yields will held low.
Okay. All right. So the long and the short of what you're saying is that you're more looking at budget and Delhi, that the bond market is at the moment slightly less interested in what Reserve Bank is saying. I can see that. That's what we started with. Now let me get to the big bankers. Mr. Setty, the Managing Director of State Bank, is with us. Mr. Setty, first your overall takeaway, but more importantly, this redefinition of bulk deposits. I thought it used to be 2 crore and above. Now they've made it 3 crore and above. How does that change a banker's life?
Lata, first I would like to say a few words on the positives. Of course, as you mentioned, the growth upgrade is definitely extremely positive. And though our house view, as you mentioned, was above 7, I think it was around 7.5 if I remember correctly. So, but 7.2 coming from the central bank is definitely a positive. And moderating inflation, though the RBI seems to be very firm that the 4% level has to be reached before the stance or any other things are revisited. On the rates and the stance, of course, is on the expected lines, as everybody mentioned, more in terms of the growth forecast being higher. And also a few things what Governor mentioned in terms of 8 core industries doing very well. In fact, that is also getting reflected in the first quarter. Credit growth usually used to be, a little moderate in the corporate side, but we see a continued growth in the corporates. The other things, very important things, what Governor mentioned in terms of systemic liquidity. I think system liquidity is positive currently. But what we have seen is that normally system liquidity comes into positive territory during the first 1 week and 10 days, and then it gets into the deficit as the advanced tax payments and the GST payments start, moving out rather. And that is where I think the comfort what Governor furnished in terms of being nimble and flexible both by way of VRR and VRRR, which we have seen in the last several months, that that liquidity support what RBI has been providing to the market to ensure that there's no problem of liquidity. I think the fourth piece, important piece, is in terms of the deposit and credit growth rates, gap increasing. That I think has been there for quite some time because of the very significant credit growth which was happening, and also some of the financialization of to other than deposits, which has been happening in the savings. But I think RBI also seems to be a little concerned in terms of wholesale deposits. You have rightly said that it used to be 2 crores on the bulk deposit definition. It used to be 1 crore a few years ago, and increased to 2 crores, and now increased to 3 crores, which means they probably are sending a signal that don't depend too much on the wholesale deposit growth to fund the credit growth. Banks like SBI, of course, with the huge franchise, have ability to raise the retail deposits, but even other banks also are mindful of the margin pressures, and I'm sure everybody would be focusing on the retail deposit growth rate. So these are a few things I thought I would share with you.
Yeah, sure. Mr. Setty, because of this redefinition of bulk deposit, do you think that credit growth could slow down a bit? Because there could be some smaller banks which now have to run for retail deposits a little harder. Do you see a rise in deposit rates and therefore any impact on credit growth as well, Mr. Setty?
I don't see direct impact on the credit growth, but I think definitely there would be higher cost which some of the banks have to pay for the bulk deposits. I think, or maybe, even the readjustment in the retail deposits also is required to be done.
All right. I'm just going to take, the focus away from the macros for a bit, because there was a lot that the Reserve Bank of India governor said about regulated entities. While he acknowledged that banks and NBFCs, have a very strong, healthy balance sheet, gross NPAs have come down significantly, he repeated a warning that as far as charging of rates and fees is concerned, in the key fact statement, for instance, the Reserve Bank of India has observed that there are still some MFIs, NBFC MFIs, that are charging very high usurious rates, and the Reserve Bank of India governor almost warned them, saying, we've been engaging with these entities, and if we continue to see these kind of observations, there will be action. The second, of course, as Mr. Setty was also highlighting, there continues to be a deposit credit mismatch. That is again something that the Reserve Bank of India governor has highlighted before, again bringing to the fore. And the third thing, of course, is RBI said that since raising the risk weights in November last year, yes, the unsecured lending book that has continued to come down, which is visible from the latest data from the Reserve Bank of India. But he also said that the Reserve Bank will closely monitor data to ascertain if further measures are needed, to monitor this unsecured, unnecessary, this large growth in unsecured lending. So those are some of the things that he said, about banks and NBFCs that we'll keep a focus on. But Mr. Rajiv, Anand, just to come back to you again on these bulk deposits, the revision of the definition from 2 crores to 3 crores, what would that mean for banks like you, as Mr. Setty was saying? Perhaps, will there be some impact on the credit front?
No, absolutely not. And good morning to all. I think the move of defining bulk deposits from 2 crores to 3 crores, I don't think is material at this stage. It's just a definitional issue. And I think, to that extent, will not impact either, growth in deposits or, credit, as both you and Lata mentioned. I think the way to think about what is happening currently is that it looks like there are two markets. At one end, as Shobhit mentioned, the long bond is rallying. We're almost at 7%. The fact that the fisc is in pretty good shape, growth will ensure that revenues will continue to be strong into the quarter. And of course, in the JP Morgan index inclusion has meant that the long bond market is quite bullish. But on the other side, if you see liquidity, through the lens of deposit rates up to, let's say, 1 year, those continue to be at elevated levels. Banks are raising money at anything between 7.5 to 7.75, And the hope that banks have really is that as government spending increases now that the elections are behind us, currency in circulation, comes back, and FX flows happen, that the short end of the curve, which is today, elevated, begins to come off, and there is some semblance of ease of liquidity as we go forward. And I think that is, to my mind, the greater focus as far as banks are concerned.
All right. And, from the statement on, that has now been released on RBI's website, we know that the two MPC members expectedly that voted against both the, rate action and the stance are Dr. Ashima Goyal and Professor Jayant Verma. Kaushik, a quick comment on this. So far, we've been seeing, of course, Professor Jayant Verma, voting for a rate cut. Dr. Ashima Goyal talking about the need for a change in stance. Now, 2 members out of 6 very clearly siding with, a shift in stance, a cut for rates. What would this mean going ahead? Just your quick thoughts on this, Kaushik.
Ritu, the thing is that, as I mentioned, that they're taking one bit closer to the easing cycle. And we've already seen some global central banks like ECB, Bank of Canada, they've started easing rates. The big one, obviously, is the Fed. And today, non-farm payrolls data is coming out. Next week, the US CPI data is coming out. So if they are like a little weaker, expectations of a September rate cut from the Fed could get stronger. And if that were to happen, then it's very possible that in October, December of this quarter, you could have RBI moving and looking to ease rates. And in order to do that, they have to make that transition slowly so that market is prepared. So one way to do it is through MPC members voting their individual whatever expectations. So you got now, instead of 5:1, 4:2, and by the time you go to August, remember, August will be the last meeting for all these non-RBI MPC members. From October, there would be 3 sets of new non-RBI MPC members. So it's very possible that in August, the numbers could increase in favor of a change of stance, or there may be an outright change of stance itself, because in July and June, inflation would come down quite significantly. RBI probably could be comfortable by that time to change the stance. And then sometime in October, December, you could start the easing cycle going into 2025. Now, always remember 2 things. One is monetary policy is forward-looking. So if you have to affect the monetary policy change into real economy, what you do in October, December might take 6 months' time to filter into the real economy. So you're not just going to look at today's number to decide what to do. You are going to look at the next 12 months number on inflation and growth, and then decide what you need to do today. So from that standpoint, I think that move has been made. And the other interesting thing Lata was asking for takeaway, one thing which RBI governor categorically mentioned is that RBI gives more importance to domestic factors while deciding on monetary policy, and not just follow the Fed blindly. It's in a way to say, in my view, my takeaway was that RBI is trying to, kind of make them more independent of the Fed in case the Fed were not to cut at all in 2024, or they have their own problems of fiscal and inflation. Then if the India inflation story improves, then RBI could be in a position to cut rates and not wait for the Fed.
Despite the RBI governor saying that multiple times, I guess the markets have continued to say that the RBI follows the Fed. And, interesting quote there coming in from the governor saying, I want to state that while we do keep a watch on whether clouds are building at the horizon, we play the game according to our pitch conditions. So reiterating that thought again, Mr. Ashwani Kumar, you've been standing by patiently. Just a quick thought on, what you made of the governor's comments on, the growth trajectory also picking up, and what it means for banks like you, especially with the bulk deposit definition being revised.
Good morning to all. As governor also told that this will be the 4th year where we will be targeting 7% growth in a row. And for the banks particularly, if we talk about, I think this is a great opportunity for the credit growth is concerned. And as we have seen good credit growth in the previous years, this year again will be the credit growth opportunities for the banks will be there. So far as the bulk deposit is concerned, it is a correction. I think only that any deposit below 3 crore now will be classified as a retail term deposit, and above 3 crore will be classified as a bulk deposit. It's not going to make much of the difference as far as the raising of deposit is concerned or the raising of resources is concerned. As if I have to talk about, say, UCO Bank, we have been maintaining our bulk deposit in a range, and in 2024, our bulk deposit as a percentage of our total deposit was lower than in 2023. So, as a measure, it's a good thing that the growth is coming. Credit cycle will again pick up. And one more thing, Governor sir talked about was the customer convenience, giving them e-Nuts mandate facility for various additional products also. I think that will improve the customer convenience and stickiness of the customer with the bank.
Okay. Thanks for that, Mr. Ashwani Kumar. I just want to ask the bankers another question on the way the governor has voiced concern on the credit deposit, growth difference. I don't know, to me it sounds like almost reading the Riot Act, but maybe I'm exaggerating. Let me read the paragraph again. In November last year, we flogged certain concerns on excessive growth in the unsecured retail loan and over-reliance of NBFCs on bank funding. Recent data suggests there has been some moderation on these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. Sounds serious. The boards and the top management of regulated entities should ensure that risk limits and exposures of each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between assets and liabilities has to be maintained. Mr. Setty, first to you. Does this sound like a warning that more may come?
I don't see as a warning. In fact, the risk weights which have been readjusted in the last policy announcements has indeed, moderated the unsecured loan rate growth in the system. Some banks might have continued the same growth rate, but I think usually we see that the unsecured loan portfolio seems to have been moderated in the growth. But the concern on the deposit growth lagging behind credit growth, I think, is voiced formally, informally by the central bank. I'm sure all of us definitely work on how do we address this issue. It is not to discourage credit growth. I don't read it as a discouraging the credit growth. Obviously, the credit growth is a function of what economy is going to perform. Macros are doing well, and if you have a GDP growth rate of 1.2, and the ballpark estimate is that the credit growth normally is, at least in the corporate side, would be twice the GDP growth rate, which means 14 to 15% credit growth rates will continue. So now we need to look at, we need to look at how do we strengthen our deposit mobilization. Maybe hopefully without readjusting the rates too much, so that the margins are not under pressure. I think it is more in terms of cautioning that we have to double up on the retail deposit mobilization. That is my reading. Okay. So, if anything, the pressure on margins could be there, you think, Mr. Setty? So, we'll see. I think while the banks have to look at their asset liability mismatches, and if these mismatches are growing, they may have to focus on liabilities. And as I continue to say that every one of the major banks will be focusing on their reach, their marketing strengthening to raise the deposits without increasing the rates, I think, insignificantly. I think the readjustment on various tenors keep happening. Even SBI has done some readjustment in the tenor-based pricing on the deposits. But I think broadly, we all will be working in terms of focusing how we reach out to the customers and mobilize the deposits. And also, as I think Rajiv was mentioning, the government spending would definitely increase the liquidity, and some of the liquidity definitely would come back to the banks in terms of the deposits. So there will be some easing of pressure on the deposit side. Okay. Let me get, thank you very much, Mr. Setty, for that. Rajiv, your thoughts? I mean, we are closely monitoring the incoming data to ascertain if further measures are necessary. Will you take it as business as usual statement?
So I think this conversation between RBI and regulated entities on LDR and unsecured lending is not new. And if you see data of banks of the previous quarter, as Mr. Setty mentioned, we have seen unsecured lending has slowed, as also LDRs have improved. For some banks a little more, some banks a little less. And I can assure you that both these issues have the attention of the senior management and boards at most large banks, and we continue to do whatever it takes to ensure that we are raising deposits, whether it is current or savings or retail term deposits, as the case may be. But I also want to importantly point out here is that as banks, we are not only looking at LDR, but also the quality of deposits, through improving outflow rates, etc., which is through the LCR mechanism.
Okay, just overall, Rajiv, would you say that there is any pressure on margin at all, even by 1 or 2 basis points, from what the governor is saying, the need to concentrate on deposits?
Lata, I think banks have multiple levers to manage margins. I think the point is that if you see the large repricing of deposits, because of the fact that short-end rates went up quite sharply, I think that is pretty much done. And on the asset side, pricing pressure has somewhat reduced, and banks are also looking to optimize, between NIMs and growth. And so therefore you will see that margins will be maintained as we go forward.
Okay. All right. Thank you very much, Mr. Setty, Rajiv, Mr. Ashwani, Kumar, Upasna, Kaushik. Am I leaving out anyone? Shobhit. Thank you very much. Shobhit, just before you go, the yields have come up to 7.02. They were 7.018. I mean, it's not a big change, but why is the bond market suddenly a little worried?
Lata, I think it could be a function of the auction. We have the 10-year benchmark auction scheduled for today.
All right.
So traders might be just creating some room to bid in the auction. So I would not read too much into, a few basis point movement.
Fair enough. Fair enough, fair enough. Well, as you said, at the moment, the bond markets are very rightly focused on Delhi and not on Mint Street because it is the budget and the nature of the deficit that will be their prime concern. Gentlemen and Upasna, thank you very much indeed for parsing the Reserve Bank Governor's statement this morning. I think the Governor has introduced a bit of drama, definitely for the stock markets. The growth estimate has been upped, and that was not anyone's base case. It was not mentioned in the poll. Some of them did mention it last week when Ritu was doing the poll, but this week after the elections, people were, if anything, wondering whether there will be a downward bias to their own growth forecast. The Reserve Bank Governor coming in boldly increasing it by 20 basis points from an already high 7%. 7% is above the median expectation on the street. There are only 2 forecasts about the Governor that I know, SBI and Citi. So the Governor bringing it up to 7.2 is a very big boost to the stock markets, and we see that 1% rally and the Nifty going up to 23,000 plus. The other positive is that 2 members are now voting against the status quo policy. 2 members want shift to of the stance from withdrawal of accommodation to probably neutral and a cut in the policy rates. That gives some kind of a dovish bias to the entire policy. It means you can't negate, you can't avoid this expectation from 2 of the external members for very long. So probably is there a rate cut somewhere in the horizon, or at least is there a stance change as early as August, is something that the government, that the bond markets will start mulling over. At the moment they are preoccupied with Delhi, but they will start mulling over a stance change as we come closer to the August policy. Ritu, thank you very much for joining in this conversation. We end our special coverage of the monetary policy. It's back to the stock markets where there is a lot of drama. That's after a short break.